Hey, thanks for joining us today on Uptime Logistics. It's powered by CAP Logistics, and I'm your host, Doug Draper. I'm with the Denver Transportation Club, and today's guest is Dave Young. Dave, thanks for coming in today.
My pleasure, Doug. Great to be here.
Dave is with USI Insurance Services, but he's also with the business school. He's an instructor at CU Denver here in Denver. So that's awesome. Yeah. So before we jump in and learn a little bit about you, I want to make sure that everybody understands this is an insurance discussion, but we're going to make it cool. Yes. We're going to make it interesting, and you won't turn this off in the first 3 minutes. That's our commitment.
As our best we can.
That's right. Yeah.
It is insurance.
But, we've known each other for a while, and I know that this will be a great conversation. So before we jump into some of our topics, just tell us a little bit about yourself, maybe how you got in the industry, and then what you do over at the business school.
The gray hair comes with more than 30 years in the property and casualty insurance industry. And before people just write me off as crazy to begin with for going into insurance, I will say that I'm a third generation insurance person. So I didn't really have a choice.
Nice. Yeah.
So, 32 years exclusively devoted to the property and casualty insurance industry. Specialize in trucking and industrial type of risks. Actually, a number of risks across the board. But in addition to that, at night, I teach for the business school at CU Denver, a combination undergraduate course called Practical Enterprise Risk Management.
Okay.
I could simply define the difference between insurance and risk management as here's where you can buy insurance to offset a risk from your balance sheet, whereas enterprise risk management focuses on the type of risks such as strategic and operational, reputation management, things like that you just can't insure for.
Yeah. Yeah, that's interesting. I certainly want to get in that because we were having a conversation before the show, and those are the type of insurance or situations you're like, hey, I didn't even know that was a thing.
Right.
So that's great. So being a pretty simple mind myself, I figured let's just kind of start with the basics, right? And, and you hear insurance and people are like, well, what does that mean? So maybe divide it up into like, okay, you can have insurance for commodities, you can have business insurance, transactional type of insurance. So maybe put it in a couple of buckets that you think would be good. And then definitely want to talk about that enterprise piece that you teach over at CU.
Absolutely. Commercial insurance buyers in the trucking industry obviously have to insure for a number of standard risks. So general liability, auto liability, workers' compensation, property, all of those types. In this environment, umbrella and excess coverage as well to protect balance sheet. Those insurances for most companies are fairly standardized. Unless you're of size, you're buying the type of policy called guaranteed cost, which is simply the insurance company takes in everybody's premium and pays out the losses. The challenge in the trucking industry is the losses that the insurance companies are paying out now are substantially larger than they've ever been. The nuclear verdict is defined by a verdict of more than $10 million is growing by leaps and bounds, creating a very unprofitable situation for insurance companies in this space. There's a number of things about traditional property and casualty insurance that trucking and logistics companies can look at as a way to try to mitigate the premium increases that they'll absolutely be seen as a result of a hardening market in insurance. And that's simply making sure that you're a best-in-class operator. For instance, the firm that I work for, USI, has an entire fleet services group that helps the trucking company comply with everything, not only safety related, but regulatory compliance and all those kinds of things, because those things are now driving underwriter perceptions about the quality of the risk and material affects the pricing that you get for that.
Yeah. So. Interesting. Tell us about the enterprise risk. That's a term I've not heard before, and obviously you're teaching an entire class on it.
Yeah,
so
absolutely.
Tell us a little bit more about what that means and what it is.
Sure, absolutely. In a nutshell, if you look at risk, we divide it into 4 categories. Starting at the top is strategic risk, operational risk, financial risk, and then hazard risk. Insurance pretty much is only designed to cover hazard risk. Some peril that causes a loss that you want to protect your balance sheet from, you buy insurance for. But up here at the top, strategic risks are things like reputation management, third-party supply chain issues over here in operational risk management, hedging down in financial, things like that around diesel, whatever it is that you hedge. But none of these have insurance components related to them. It's really down here where people are buying insurance for hail or workers' comp injury or whatever it is. However, management these days is under increasing scrutiny to really focus on the risks that typically drive companies out of business or significantly affect shareholder value. Those risks truly are things like reputation. How do you manage that? And really, in an enterprise risk management scenario, basically what you're saying is we have a number of risks that we cannot buy insurance for. So the only other choice that we have is to mitigate that risk. Use some sort of risk mitigation strategy to lower the likelihood of an incident. To do that, the company obviously needs to have key risk owners who are basically in charge of these special risks that can't be offset off the balance sheet, and that forward progress is being made to make sure those risks are mitigated. Those risks are the ones that materially affect companies. As we'll discuss, there are scenarios where insurance is now driving companies out of business, just the sheer cost of it. But in a lot of instances, it's these other types of risks that senior management of companies really need to focus on, because there is no way to offset that risk. A couple of trends in the trucking industry specifically, and I know your business does a lot with Colorado Motor Carriers Association here, so it's great that we're talking about the trucking aspect of it. But you said the nuclear verdicts and other things like that. But just literally a couple of days ago, there was a company in Illinois. I think it was BK Transport or BK Trans that did exactly what you said. There was 3 factors that came into play while they're just closing their doors, and one of them was insurance cost. And there was one thing that created that higher insurance cost that both you and I saw that kind of was alarming. So tell us about what you saw in that article. Well, that article that you sent over, probably an astute decision on the part of this 20 trucking company to shutter their doors for a year to see what they can do. They're losing money on insurance because their out of service rate was 43%. That's going to show up and stand out prominently in a CAB report. CAB reports are now one of the key underwriting tools used by trucking insurance underwriters to evaluate how risky this operation is. And since that's significantly higher than the national average for out of service, something's amiss there. It could be a driver shortage where they can't find quality drivers, and they're taking the risk of putting not quality drivers out on the road.
What is the national average? So this group was at 43. What's the national average that you see out there for that statistic?
I'd need to reference the CAB report. I want to say it's in the low 20s, so double at least the national average.
That's going to jump off a piece of paper for sure with an underwriter.
It's going to stand out, and you will not get favorable pricing. And it's becoming such a high cost percentage of doing business that it's absolutely now material to every trucking company. If I could give you a quick example from the insurance industry, when we look at property and casualty insurance for general industry, let's say, we're typically using what we call the 1% rule to estimate what their spend is. For your general industry company, it's fair to say an average sized company should be spending about 1% of gross revenue on property and casualty insurance coverage. That's our benchmark when we go in and try to estimate the size of a company that's not currently a client. In my experience in the trucking industry, probably the highest that I've seen at any one point was 8% of gross revenue. That's huge. That is right at the top of your expense line items. And in my opinion, going forward, the ability to control insurance costs will become a competitive differentiator between trucking companies.
Mm-hmm.
The ability to say, I pay half of what my competitor down the street does because I'm doing all the right things in terms of driver onboarding, training, ELD, everything.
Yeah. Like literally leading into a discussion like, hey, I want you to use my services versus trucking company B. Before, most people could care less about your insurance, but you're saying it's getting to the point like, here's all the things that I do right, and my insurance is lower because of that. And that's actually a discussion. What you're saying is you'd have up front versus and make it front and center.
If I was evaluating trucking companies to hire and I knew about instances like BK Trans, I'd be absolutely concerned about what their current and pending future insurance costs will be. They might not be in business in 2 years if it gets any worse.
Yeah.
But to be able to bring out your cab report and say, look, we are best in class. Now, best in class trucking companies, especially those of size, will have options in the marketplace that they can look at to potentially reduce those costs.
Yeah. We talked a little bit about technology and how that's impacting the insurance. Right. And I know that the process of managing insurance from your side of the house, it's still, there's not a whole lot of technology out there that's changing that. But what is changing is the technology that the drivers have. And we specifically mentioned the ELDs.
Right.
And you're talking about the cab report where you can't hide what you're doing out there anymore. And when this data is front and center, actuaries are going to take a look at it. And is that kind of what you're seeing? Is that the visibility out there of what's really going on is driving the cost?
You know, you're having a lot of issues with violations in the last mile. Drivers trying to get home and they're running up against the limit.
Right.
Unfortunately, as we sort of talked about, we essentially live in nearly a surveillance society these days. I pretty much act as if I'm on camera all the time.
Yeah.
Because there's a good chance that you are.
And you are right now.
Yeah. Didn't need to be reminded of that, but thanks. But there's no escaping in-cab cameras, ELD devices, and all of that data is going to now show up on the underwriter's desk.
Mm-hmm.
There's no escaping it. I will say I made a comment where, the insurance industry is about the least technologically advanced industry there is. I think we still do it the way we did it in the 1900s, but be that as it may, we now have much more information off which to evaluate a potential risk.
Yeah, I could see that.
Yeah.
Well, we're talking today with Dave Young with USI Insurance and a phenomenal professor at the business school at CU Denver. So we're always into stories and examples in our conversations here at Uptime Logistics. And I know we were talking a little bit about some examples. We spoke about the trucking company in Illinois that just went out of business.
Right.
Are there other examples that you've seen where trucking companies have had negatively impact because of insurance situations? Maybe there's a handful of, one or two examples that can help paint a picture for our audience.
I think people can, while the insurance industry typically does not get a lot of sympathy, I think people can start to understand some of the challenges that the insurance industry is facing with the trucking industry. One of the most prominent cases of just a few years ago was the judgment against Werner off an accident in Texas, where the settlement was $90 million. People were blown away by the size of that judgment, only to have 2 months later a larger judgment against FTS, a fracking service, again in Texas, where the judgment was $101 million. Those two immediately shot to the top of the largest verdicts in the trucking industry loss history, only to have in 2018 Schnitzer get tagged with a loss that was $260 million as a result of an accident in Louisiana where a truck did rear end a family of 5 in a vehicle. All 5 passengers were killed upon impact, but that $260 million settlement only involved one of the passengers. Now the thing to understand about Texas and Louisiana from the insurance industry perspective, they typically get multiple spots in the top 10 judicial hellholes in the United States. There is an actual list, and there are a number of parishes in Louisiana that are always at the top. And unfortunately, what happens in these judicial hellholes is the jury of your peers is very inclined to find the deepest pocket they can and award you everything that they want to. In that $260 million settlement, $100 million of that was just for punitive damages. In the $101 million case, I think it was $75 million in punitive damages, which in many states is not an insurable item. In some states it is, and you can buy punitive damage coverage in Bermuda, but it goes back to this issue of your insurance costs are going through the roof and becoming a material expense item that affects your profitability.
So what do you think, and this is more just kind of a personal comment, right? I mean, there's been accidents for as long as trucks have been on the road and long as humans have been driving. What has happened to have, the nuclear verdict? I love that term.
Right.
You just mentioned 3 that have all happened in a matter of like 5 to 10 years.
Yeah.
There were accidents in the 50s and the 40s and the 30s. What's happened that's had these verdicts just astronomically high? Like what has changed in your thought?
It's unfortunate, but I think, as our society becomes even more litigious than it has been, there is an expectation on the part of people that if you're hurt and there's a deep pocket, you deserve probably more than is reasonable and certainly more than is ever contemplated by an insurance company around the value of the life of one individual. It's a lot of these large judgments are being driven by punitive damages where the jury wants to punish the company for not adhering to its own policies, driving a substandard driver, which was one of the cases right there. But to teach them a lesson. Unfortunately, what the lesson has become is the insurance companies are like, it is in our best interest to settle these cases out of court as fast and as quickly as we can so that we're not looking at a multi-year litigation where we end up with a huge judgment that we'll then spend years appealing. There's a rush to settle those claims. As I mentioned, the other 4 fatalities in that last accident, that hasn't even been settled yet. But
unbelievable. I mean, is Snitcher still in business?
Yeah, but they're a substantial size. And so a lot of times it's the larger companies that are penalized the most because the juries in assigning punitive damages are saying, well, let's give them a percentage of the company's revenue.
Yeah.
And that number can end up being very large.
Yeah.
Insurance carriers for the cost of umbrella from, say, $25 to $50 million, they're really not getting that much premium.
Yeah.
And they're getting more and more of these verdicts.
Yeah.
And so what we see in our industry is, especially for trucking, across the next couple of years, substantial rate increases just across the board. USI recently put out its State of the Market report for 2020. Every single line of insurance coverage is going up, most cases in double digits, except for workers' compensation. To the automation, the robotics, everything else is making most workplaces safer. And so that's driving down comp costs. But it's the only line of coverage.
That's interesting. We were talking as well about unintended consequences of requirements and things in the trucking industry. There's the driver shortage, right? We've talked about that multiple times on the show. As the workforce ages, the interest level is waning with new folks coming into in their 20s and 30s.
Right.
So what's happened is that I know that there's some legislation out there to say, well, let's allow younger drivers, as young as 18, to be able to cross state lines. They just need bodies in those trucks. But I could see just the unintended consequences. Yeah, hey, we got an extra 15%. And now my driver force age just went from, I'm just using an example, 30 to 27. That's going to, pop a red flag as well. So to me, that would be an unintended consequence. We need bodies in the trucks. We're finding them. They're young guys and gals, and they're super interested. But from an insurance perspective, like, that individual has minimal, if any, experience. And I'm sure that's a red flag on the insurance side.
Absolutely. And in fact, make sure your policy doesn't restrict you to drivers over the age of 21, as that's very common. So might be a great idea to want to do this, but make sure that you have the leave to do that. And we'll have the insurance coverage to back up those very young, inexperienced drivers.
Yeah.
It's from a future risk perspective, it's an interesting conundrum for the trucking industry. A lot of drivers are aging out. We can't pull enough people into the industry to fill seats in trucks. Yet if you look at long-term emerging risk, a long-term emerging risk for the trucking industry is robotic trucking with no drivers. So at the number one list of careers at risk from artificial intelligence, number one is accountants. We don't need those guys anymore, but truck drivers are right at the top of that list as well.
Yeah, that's interesting. So kind of a future trend, how do you think that with the automation of trucking, right? And I think the most realistic, in my personal opinion, that will happen is platooning, where there's still a human, but there may be 2 or 3 trucks that's following them in the platoon. Is the insurance company welcoming that, saying, hey, this is great because we're going to have to manage less risk? Is it to be determined? So all the automation that's going to hit literally in the truck, what's that going to do for the insurance industry and ultimately the owners of those companies?
Honestly, it's still a little bit of a head scratcher for us, because where are you going to assign the liability to a self-driving
That's
vehicle?
exactly what I was thinking.
Right. I believe that that platooning concept is currently being employed in Europe with large convoys of trucks going down their freeways with mostly unattended vehicles. It's interesting because, yes, we are still scratching our head about how we're going to do all this, but we can't ignore one important fact that's being discovered as a result of Tesla and other potentially self-driving vehicles. Their accident rates are so much less than human-driven vehicles. You can chalk up most accidents probably to a lot of human error, and that's not happening as much with AI vehicles.
Right.
So there's actually a concern in the insurance industry about the collapse of the auto insurance segment of our business. Are we going to need that many underwriters? Are we going to need that many adjusters if most of the trucks on the road aren't even manned? That hasn't been worked out yet, really, to any degree of sophistication.
Yeah. Another example of unintended consequence, right?
Absolutely.
On your industry.
So you're trying to drag all these people into a job that will be declining in the future. It's difficult. Yeah.
So let's take a positive spin, right?
Okay.
So we've talked about all these things, and here's the trends and the chaos. Give us some thoughts or advice, right? I know you work with CMCA pretty regularly, and obviously your company does a lot in our industry.
Right.
What are a couple of what's some advice you would give? 1 or 2 points. If I own a trucking company and I'm trying to mitigate the risk, what are things I can do so that's not going to put me out of business?
I guess my first piece of advice would be get creative. There are creative ways to design a risk transfer program that, unless the firm that you're working with has the requisite level of specialization, they might not bring it to your attention. One that we've talked about is this concept of a stock throughput. So in standard property insurance, you insure buildings and then you insure business personal property. A lot of times that's goods in transit. The program we talked about as a stock throughput is to take all goods being transported from the point they start to the point they end and put them under what's called a stock throughput policy. That ensures the goods at selling price, so you don't have as many issues with claim settlements. much broader perils are covered at much lower deductibles. It's a much better way for the right trucking company to insure itself and potentially, as we've discussed, provide a competitive differentiator in the way that they manage cargo losses. The other thing and to build on that point, just this week, I was having conversations with our market partners in London about putting together essentially a group stock throughput program to take the smaller companies that can't necessarily employ this type of strategy because of their size or whatever else, but bring them together to sort of pull out that cargo component piece and make it a more efficient risk transfer vehicle. The other thing I would say is definitely, if you're a trucking company of size, evaluate your options. There are a number of type of specialty insurance programs, such as group captives, single parent captives, risk retention groups, where essentially if you're a best-in-class operator, you're going to pay basically what your losses are. And if you don't have losses, you will have the lowest expense for insurance possible. Funny enough, in a group captive, the only way that a trucking company can get into a group captive that specializes in trucking is to be voted in by the current members. So the other trucking companies evaluate the trucking company that wants to join because these trucking companies are best in class and they share risk with each other. So they'll only take the best of the best. The brokers, the insurance companies, they don't have any say. It's the other trucking companies.
Yeah.
So
yeah, I guess the days of saying bring in 3 insurance companies and 1, 2, 3, pick the cheapest one and let's move on. That's not going to get it done. It sounds like you need to get creative with these collaboratives and other things.
Absolutely. Because the 3 options that you're going to have in front of you, none of them are going to be affordable.
Yeah.
Every one of them, even the lowest price one is going to be like, oh, I don't like insurance.
Yeah. That's interesting. What if our audience wanted to learn a little bit more about some resources, right? So I own a trucking company or things of that nature. What are some websites or some resources I could go to learn more about my options as you need to become more creative?
Well, from the insurance company perspective, there's not a lot that we as an industry provide to the trucking industry in that vein. I will say that, as I mentioned earlier, we have an entire fleet safety services group. There's organizations like J.J. Keller and others that can provide all the tools necessary to make sure you're hiring the right drivers, you're onboarding them correctly, you're complying with every current regulatory update, of which there have been several in just the last year, that make it more onerous for the trucking company to operate. Having those tools and then using them will make you that best-in-class operator that will get you the best result in the marketplace.
Yeah. It's a daunting discussion, daunting. And I think unintended consequences that we've mentioned is real. It's in your face, and you just need to be, like you said, creative and think outside of the box, to use that term.
But the last thing I would caution people is to say anticipate that it's going to get worse before it gets better. That's a natural function of the losses that the insurance industry is taking through natural catastrophes over the last several years. The fact that insurance companies cannot generate any investment income in today's environment, and they have to focus exclusively on the underwriting quality of the risks to try to achieve some sort of profit. And unfortunately, the insurance industry typically works in multi-year swings. And to the benefit of many companies, for the last 20 years, it has been a very soft market in insurance. I'd say easily over half the people or more that work in the insurance industry have never actually even seen a hard market. The last significant one was in the mid-'80s. It gets ugly fast. Yeah. And all I can do is encourage folks to do the effort necessary to be the best operator they can be. Yeah.
You better have a plan B, and you better get creative.
Yeah.
And the days of lining up 3 insurance providers and say, give me your best price is probably not sustainable in the future.
Not only is it not sustainable, given how benchmarking for trucking companies has changed, like we actually recommend you buy a lot higher limit. We're getting to the place where we can't even obtain that limit. The market does not bear it anymore. So if you come and ask me for $100 million in coverage, depending on your risk profile, I'll be like, best I can get you is 50.
Yeah.
Just hope you don't get one of these crushing verdicts.
Yeah. Interesting.
Pretty tough times.
Well, it's been real enlightening, and I think we did a pretty good job of keeping it interesting.
Okay.
You did a really nice job of keeping it simple and using our examples with explaining to our audience.
Yeah. Thank you, Doug.
This is a real topic. So.
Yeah.
And I'd like to thank our audience for joining us today on Uptime Logistics. Of course, it's powered by Cap Logistics.
Yep.
You can find more information about the show in the description below. And don't forget to like and subscribe to our channel. And please visit caplogistics.com for all your customized transportation solutions. And I would say this show of Uptime Logistics was successful because of you.
Thanks so much, Doug. It was a pleasure.
Awesome.
All right.
Thank you all.
Thanks.